One of the questions that I get a lot from traders is, when should you take profit in the market? You put a big take profit that's like really far, go for these high reward trades, or should you maybe go for like a lower reward to risk and a high win rate? What's the best? Well, there's no best answer to it, but I thought I would answer the question here for you guys. And we did a awesome mastermind call a few weeks back for my Desire Trade Academy program right over here. Every 2 weeks we do a call, we teach the topic a little bit, then we ask for feedback from people, we do a discussion, people can connect with other traders, can ask questions, can share their challenges, share what they're facing, and they can kind of grow and become better as a group in the program. So I'll play that part of the mastermind call over here. It's a whole training. It's a pretty intense call, but you'll learn how to place the right entries, whether you should go for home runs or small targets in the market, and how to decide for both, and use the skill from a professional trading to your own trading approach. Let's dive right in.
Let's look at when. Okay, so we go for the home run. We're going to look at when, why, is there a time threshold that we have to consider? And of course, you have to throw in risk management, because risk management plays a role in this decision-making process. Okay, so let's start with when. Is market context a factor in your decision? And I put selectivity component. Let's get down to the nitty-gritty. Is going for the home run or trailing in a chop strategy or a chop market going to have different outcomes than in a trending market? Absolutely. So when someone asks me, should I go for the home run, or do you trail, or where do you put your targets? What R do you put your targets? I hate to give that answer, but it depends. What is one of the factors? Is market context. Am I in a chop market, or do I have a chop strategy? Is that going to determine, do I trail or not? Why? Why do we want to go for the home run in the first place? Well, if the market's making it available to us, that's great. So probably you want to take advantage of it. That makes sense. But is the why part of greed? Because if we're going to trail and we hit our first target or two, we're in a winning position and we have green on the table that we haven't taken yet. Is greed a factor? This is something I want you to ask yourself. Why am I doing this? Is it a high win rate? Do I want to have a higher win rate? And let's make an assumption that if you took your first target or two, you're going to have a quote winning trade. But I see a lot of people focusing on this metric of high win rate. Okay. Is that part of the decision you're thinking in your decision making process? How about that trend is your friend thing that we all hear about? Well, of course I'm going to trail. The trend is my friend. Well, let's see if the math is your friend. And we did a whole mastermind topic on that about a few months back, but we'll address the trend is your friend thing. I cringe every time I hear it. So the why. Ask yourself, why am I doing this? Let's look at the next one, the time period. At what time threshold is your patience tested? And I ask that question. Again, these are individual questions. And you can see how, should I go for the home run? Yes or no? Do I trail or shouldn't I? Sounds like just a binary answer. When you're trailing, you are tested in regards to your patience. Right? You take target one, it's a quick little scalp, or even like a 1-to-1 risk reward. Business as usual, move on to the next trade. Rinse, wash, repeat. But when you're trailing, is there some point where you get frustrated, or you look to get out, or you violate your trailing plan, your home run plan? Going for the home run sounds pretty, and when you have them on your journal, they look great. But if you'll notice in Slack, when someone has a nice trade and they really held off, the first thing I say is not great win, great trade. I usually respond by saying nice patience, because these home run trades test your patience. And that could be very frustrating, because like everything other than non-Japanese yen pattern pairs, most of the time home runs come into a lot of chop and they give false signals, or they give you plenty of opportunity to say, maybe this trade's over with. So keep that in mind. What is your patience level and your patience tolerance to taking home runs in the first place? Number 4, risk management. Are we taking some trades off early to reduce risk? Not saying it's a bad thing. I'm a risk manager by trade, so I'm telling you it's not a bad thing. But the reduction of what? What are we reducing in regards to risk management? Let me give you an example. Is taking target one, all right, and let's say that's a relatively easy target, and then we're going to go for the trail. Is it actually risk reduction? Is it risk reduction of the trade? Probably. All right, you're taking some off and you're locking yourself in for the, maybe a minimum of break even, clearly it benefits on the risk management side of the trade. But what about your business, your trading business? If we're taking risk off on a trade and we keep doing that, and it's not the optimal method, at least as far as what the math is telling us, are we, in essence, putting our business of trading at risk? That's a little heavy, but I want to include it. And this is this is the academy here. I like to throw in some of these things that really challenge your thinking. So what you're saying, Mike, is I could be reducing my risk on the trade, but really ultimately, if I left it on there and didn't get out at the optimal level, I'm actually putting my trading account at risk. The answer is yes. Okay, we'll talk about that. So what does the back test say? Is the profit factor difference being in a trending versus a chop market different? We talked about that early in the when. If I'm going to trail in a chop market, what is the profit factor versus doing a back test in a trending market? Okay, the profit factor should be that eye opener saying, okay, maybe I should be more selective. Or maybe your strategy says, doesn't matter, go for it. What does the back test say? Hints about historical data, math. So before we move on to the next slide, I just want to make sure we understand this point. By reducing risk on the trade and not taking as much meat off the bone as optimally and historically it says you're allowed to, you actually may be putting your portfolio at risk and your trading account at risk, because remember, these winning trades are going to pay for it. Make sense? Let's take a look at some math and maybe some of the solutions, just in case I haven't confused everyone enough. See such a simple question of, do you trail or do you take stiff targets? Get that all the time. How do you answer that? So let's see what the math says, and that will allow you to make a decision to say, okay, what's going to be my game plan on trailing versus not trailing? Here's the bullet. Interesting. And these are just results in market studies. I use Tasty Trade for a lot of my data in research teams. So the math says that there is little difference in results in overall outcome of trailing versus taking stiff R targets like R1, R2. Okay. What this is the efficient market theory put into testing using Black-Scholes models and all this other kind of stuff. That's interesting. So what we're saying here is the math is saying kind of there's nothing to determine, no major difference. Very interesting. The results, and this should not be a shocker, bullet number 2, the results did slightly better in trending markets and slightly lower during non-trending markets. This you do not need, a research team to make that conclusion. But I want to emphasize the word slightly better. Okay, it wasn't big difference. Only strategies that, and I'll discuss relatively, other strategies that relatively outperformed regularly was when set targets were used and then the capital was redeployed to other trend-based strategies with the original historical edge. What the heck is Mike talking about here? I probably should have reworded that. What basically the model or the research was saying that the strategies that outperformed regularly when there were set targets versus the trail factored in the fact that you took that money and because when you took the stiff target, you have the money back in your account. You use that when you were trailing, that capital was, quote, unavailable. Okay, this is what they call the meat off the bone approach. It's rinse, wash, repeat. When you're in a stiff target style strategy or a methodology, that capital is available to you. More capital is available to you. If you use that with other strategies that have the historical edge, it leverages your performance, your results, your profit factor. Does that make any sense? It's a little heavy, a lot heavier. When I was preparing the slides last week, I didn't think it was that heavy, but it is. So ask yourself, and this is sort of the test of bullet 3. If you took a stiff target at T1 or T2, would you use that capital to re-enter a new position that has the same historical positive edge? That would answer the question number 3 is if you're not, then it's almost sort of moot in the sense where if you're not, you're going to use the capital to redeploy right away. It's not going to be much of a big factor. But here's the 4th bullet. I want to reiterate the last one. Would you enter a new position at the price of T1 or T2? So if you're trailing, all right, so you have T1, then you hit T2, and then you're going to trail. Ask yourself this test. At T2, where you're going to keep a portion on, would you enter a new trade at that price? Now, my thinking is, and assumption is that when you hit T2, it's moved like price that you could possibly get, right? Because it's moving in a direction, you're taking T2. Wipe the slate clean, wipe the chart clean. Stop and ask yourself, would you put on a position at that price? The answer is, that's what you're actually doing, because you have an opportunity to take off the whole trade, but you opt to keep one on. So in essence, you're actually putting on a partial position at that level where you took off it at T2. Again, part of what I like to do in the Academy's mastermind classes is to make you think a little bit and say, okay, I got this information. The math is telling me, okay, not a big deal. What am I going to do? So let's take a look at some practical takeaways that can help you make the decision of should I trail or should I not trail? Okay, because I don't want to just throw a bunch of theory in. I want to make sure you have practical stuff you could use in your trading. So, one of the takeaways: if your historical results or backtest has an edge in all market phases, don't change it. I mean, you don't need a coach to tell you that. If it's working, let it be. Okay, maybe there's a way you can optimize. There's an optimal level and things like that. But for the most part, if it's working, keep it the same. You have a positive profit factor. And I would say consistently positive profit factor. Here's the thing. If trailing has a slightly higher edge in a trending market, how strong is your ability to identify a developing trend-based market? That's not easy. And when I say identify a developing trend-based market, sure, you can look at a trend market and say this is a trend market. But can you identify the things that are happening, maybe in the internals, that say this looks like it's chopping now, but it may change into a trend market? It's a very difficult skill set, by the way. Next one. Risk management needs to be considered at the business level, not just individual trades. All right, we talked about that just a little earlier. Is when we're taking some off the top, we're reducing our risk on the trade. But if the optimal level, or based on our back test, is saying, hey, you should hold to this amount, you're actually taking capital, you're taking profit potential, you're losing meat off the bone, so to speak. And remember, those profits have to pay for the losses. So this is something I want you to consider. Are you looking at the trade level and not your overall portfolio level? And I put here in parentheses the window dressing factor. And really what that is I do this a lot too, particularly in managed accounts, where I will adjust my strategy that goes against the optimization of what I should be doing. Quite honestly, I want a positive month. I want to end the week on a positive note. I don't want to have a positive week and end up break even. So I'll manipulate things just for the psychological confidence factor of my trading. Is that correct? The math is saying no, but confidence to me is one of the most important things. Even from someone doing this for a while, I still want to maintain that positive confidence. And also, quite honestly, when I have to do reporting from my managed accounts, I want them to be very happy. So what does someone do when you really don't have an answer? You throw out a hybrid approach, a little bit of both. Consider the hybrid approach using internal exit data points with Edge. And we're going to give you a couple of examples. As opposed to fixed R. I have a little pet peeve when people say, like, what's your R? Is it 1-to-1? Or, I take 5 points, or, 20 pips is my first R. Market doesn't care about your R per se. But instead of using price points, look at internal exit data points that have an historical edge. Support resistance would be a logical sort of a basic core example of internal data points. I'm going to take these targets, T1 and T2, at the next resistance levels. Right? That's not a price point per se. That's an internal thing that historically, at least I hope, you have found that it hits those support and resistance levels. And I threw other ones here: 5-dot rule, 3 push exit, if thens. Let's just look at my last slide of a couple of examples that Again, they're not the secret sauce or anything, but these are sort of things that I use internally, right? An internal data point that I use rather than just price. So I think we have one more slide, right, Alex? And again, this is, I don't want to teach this class on like indicators or anything like that. But when I look at my targets, basically my trailing or stiff is going to be using internal data nuances that have an historical edge, like I just mentioned. So let's look at the first in the upper left, right? I call it a 5-dot extreme, right? Just so you know, for definition, this dot basically captures, in this particular example on a daily, I believe, it's the highest point. The dot is the highest point in the last 21 bars, okay? And I use 21 here on a daily. It's irrelevant. What it basically tells me, though, historically is once that first, quote, break dot appears, the average is about 4.5 to 5 that follow. Okay, that's the general historical thing where it keeps pushing and then finally runs out of gas. This is on ES futures. So where do I set my target? At the 5th dot. When the 4th dot prints and it breaks out to that new bar, that's it. That's my target. Okay. So it's not a fixed target per se. This is something that I'm measuring. But historically, that gives me the optimal edge that I have discovered, and I'm going to use that. It's not a support and resistance. It's not a 10-point target. That's it. There it is. Another way of using internal method is the third wave exhaustion. With a particular trend, on average, you get a push down, a retracement, another push down, and then that third push. Right? Is it always 3? Of course not. Okay, it could be 25. But on average, it's about 2.5 to 3. So when I'm short, in this example on number 2, I got my dots going, I got this, maybe I'm taking some off. I'm going to look at, and that third push, okay, there's going to be my, quote, trailing exit. Doesn't matter about points, doesn't matter about R&R. That's it. Because I know historically, these moves just get exhausted. Another internal example, and again, this is probably more toward with futures and equities. I know, Pierre may be familiar with it. Is, or for those who do, futures and equities, is I use a tick chart, and what that is every time it calculates, it has 1,000 New York Stock Exchange stocks in it, and every time one of those ticks up, it goes up by 1 point, and then anytime a stock ticks down by 1 tick, by 1 penny, it goes down. So that average is what gives me that. What it does is it shows me very, very short-term exhaustion. All right. So when I have a trade with multiple targets, my first target is not a particular price point. If I'm long, it's going to be where historically extremes sort of happen. These like sort of pushes extreme. In the tick chart, it's generally around 600 to 800. In really big crashing crazy markets, it could be over 1,000. But at that point, there's probably going to be a little pullback, and most of the time it's just profit takers. But I want to take an internal piece of data that has an historical edge, and I want to optimize that in my taking my trail. So I'm going to go for the home run. So it's going to be my first target. This is my second target, and then maybe the third target will just be, say, a third wave exhaustion. Or if I'm using just say moving average crosses, maybe it's like on the third wave when the crosses go against me, something like that. The point of this last example of practical examples is when people ask me, how much is your R? The question is, I don't know, my internals, my dashboard of my car is going to dictate what that is, as opposed to these sort of manual 10 points, things like that. This is a little heavy stuff, a little bit advanced for you guys in the academy, so this should be expected. But it asks that question is, should I go for the home run? All right. So I want you to consider math, not much of a difference. Again, the math says that you should hit a home run. Sure, you're going to have a big trade, but if you took that capital off at T1 or T2 and then redeployed it somewhere, it would make up for those long ones. And then use internals like your dashboard as opposed to just cookie cutter price, right? Something I want you to consider. One last thing, and this is something that, again, I mentioned sometimes goes against the math, like in a window dressing, is if you're having a good week, on a Friday, I definitely like to trail. If there's a trending market, I will trail and go for the home run, because that sometimes will make good weeks, and great months. Those every once in a while, but I'm not going to push something on, say, a Monday, even if it's a perfectly, charted plan with maybe resistance way out in the, no man's land. All right. I want to start accumulating green. That's just a window dressing approach that I don't know if anyone has used, but that's something where, it's very helpful in the area of confidence.
Pretty in-depth stuff. I hope this was useful, of course. Hope you got some value out of it. Leave me your thoughts below in the comment section. As always, I want to know what you think. If you like these kinds of training, if you like me to take some extract from my paid courses, put them on YouTube for free, let me know in the comment section below. I'll be happy to do more of those. The details will be there also if you want to join the academy. If you want to start working with me and a few other coaches to become a full-time trader in the next couple of months, we help people do that. We help people quit their job, trade full-time. It takes, of course, some time. It's not something you will do in like a week or a month. It takes many months to get there. But we work with people really closely. We do some coaching with them. We do these calls every 2 weeks. And these kind of things really help them to progress and become better traders. So the link will be below to apply. Check it out. Make sure you're subscribed to the channel, because I publish 3 videos like this every single week. Videos to help you become better in trading. One interview, 2 other videos. Why teach you stuff like this in trading. Don't forget, we still have a giveaway going on. I'll leave the link also below for that. The giveaway has a few days left. And I'll catch you back here in the next video pretty soon. Ciao.